It gives me great pleasure to welcome on board Morgan Housel. He's just penned down his first book, The Psychology of Money. And what's really unique and special about this book is how Morgan really approaches a lot of different personal experiences and examples on how one should deal with greed and fear, how perhaps you sometimes have to overcome situations in life, even sharing his unique personal experiences, such as overcoming his stuttering habits as a teenager. And some of these instances are really what make the book so special. Morgan, you've gone out and really tried to articulate, explain how you don't need to be some kind of financial guru or financial whiz to make it in the stock markets. But the question I want to ask you is, if investing was so easy, or if really everyone could get the hang of it so quickly, wouldn't we then see many more billionaires today?
Well, I think there's some truth to that, but the one nuance I would put to that is it's not easy. It's not complicated, but it's not easy. And the emotional part of finance, where you don't have to be an expert, you don't have to have gone to Harvard Business School or work at Goldman Sachs, that part is still true. But that does not mean that everyone can or ever will master the emotional side of investing. It's always going to be the case that a pretty large subset of investors who try to endeavor to be long-term investors will struggle with long-term thinking, will struggle with greed and fear. I think there are ways that you can better understand yourself and become introspective about yourself and try to understand your own risk tolerances better. But we're never going to master, as a whole group of investors, as a society of investors, we're never going to master the behavioral side of investing ever. And that's really an important point, is that in the last 100 years, we as investors have become more informed, and we have more data, better data, of course, faster computers to process that data. But we have not become better at mastering the greed and fear at all. I think we are just as susceptible to the boom bust greed fear cycle today than we were 100 years ago, and we still will be as a group 100 years from now.
I mean, in fact, if we put that in context of just the current year, we've seen, a major cut and a comeback, all in the span of 6 months that we've seen greed and fear play out. I mean, that's really unprecedented. Do some of the same principles still apply, given that we've seen this?
There's certainly no precedent for what we've been through this year in terms of going something, in the United States close to the Great Depression, and then stocks were back at all-time highs in the United States within 90 days or so. It didn't really take that long for us to get back to all-time highs. There's not a lot of precedent for that in history. I do think that, look, the boom-bust cycle at the economic level, in terms of, a different economies' propensity to have big surges and then crashes, deep recessions, market crashes, market panics, that's never going to go away. We're never going to get rid of that cycle. But I think there's an argument to make that maybe it is a faster cycle now because of central bank policy. So maybe the booms and busts are deeper, they are more accentuated, but they happen faster. We've kind of saw that after 2008 as well, where, look, it took a long time for the economy to bounce back and for jobs to fully bounce back. But the stock market did very well coming out of March of 2009. And we've definitely seen that this year as well, where we had a very, very bad, deep market correction in March, of course. But then you had so much central bank policy just pouring fuel on the fire, so to speak, that you've had this massive stock rally over the last 4 or 5 months. It's done really well for investors.
Morgan, you started penning down this book, I think, last year, and then we've seen the pandemic hit while you were sort of midway. Did it affect your thought process at all?
It didn't, because I wanted the book to be timeless, things that have affected investors for 100 years and will continue affecting them for 100 years. So there wasn't that much that I think is missing in the book, given this new world that we live in. I think there are some parts of the book that were definitely reiterated in 2020, and what's happened in 2020 are examples of what's happened in the book. Just things like the basic thing, like the cost of admission in investing is dealing with uncertainty and volatility. That's written in the book. That's a point I've been speaking about for years, but 2020 is a really good example of that we've had a very good bull run in the United States over a decade period, but the cost of that, the cost of admission for enjoying that, is putting up with uncertainty that we've dealt with in 2020. That's what you have to put in. So it's not necessarily that things would change in the book, but I think a lot of what's happened in 2020 has actually verified some of the broader topics that I wrote about in the book.
Okay. Do you think that, there has always been a lot of idol worship when it comes to Howard Marks, Warren Buffett, and some of the global gurus. But do you think that perhaps there's a risk in following them because each one has their own unique principle?
I think what's really true is that in any sort of extreme success, like the people who we tend to worship, there is always a degree of luck. It's not that it's 100% luck. Of course, there is skill in Howard Marks and Warren Buffett, et cetera, all those people. But in any sort of extreme success, there is a level of luck. I write about in the book that Bill Gates went to one of the only high schools in the United States that had a computer, and that was his introduction to computers. Of course, that is a level of luck that he himself has talked about that led to his success. And it's not to say that Bill Gates is not smart or hardworking, but there's always that level of luck. And whenever there is a level of luck in that kind of extreme success, it makes it harder for people like myself and you and everyone else out there to look at those people and say, well, if I do what they did, I'll get the same results. Because you're not necessarily going to get the same amount of luck in the same sequence that they did. So my broader point with that in the book is we need to be careful about who we worship and make sure that we are taking away the broadest lessons from those people rather than the very specifics of exactly what they did and assuming that what they did, if we do it, will lead to the same results.
Sure. All right. Now, information, far more accessible today. To what extent do you feel that that makes it perhaps easier or gives investors an edge? Or if you feel in the past information or those who had access to it had the edge, what would today be the new sort of magic wand that investors could perhaps use to give themselves that little bit extra when it came to looking at the stock markets?
It's definitely true that the information that we have today that is readily available, that anyone with a smartphone in the world can access instantly for free, that same information was a legitimate investing edge even 10, 20, and definitely 50 years ago. And so that's not an edge anymore. There are data sets that some of the best hedge funds have that truly are unique data sets that give them an edge, give them an insight. But for individual investors, or even the vast majority of professional fund managers, by and large, information is not an edge anymore. There are stories from Warren Buffett that he would go to his local library and read about these companies that no one else in the world was reading about. That used to be an edge that doesn't exist anymore. So in my view, what becomes an edge in that world where information doesn't necessarily give you a leg up anymore is behavior. And that's something I've been writing about for years, is that if you don't have an informational edge, and very few people do these days, then I think where you can find an edge and be better than others out there is through your ability to be patient, through managing your relationship with greed and fear. We know those things lead to successful investing returns over time. And we know that a lot of people are susceptible to falling victim to those kind of things. So if you can find your edge in something like that, something that you can control, something that you have your ability to turn the levers, to turn the knobs, that is something that you can gain an edge with over time. It's difficult, and not everyone will be able to do it. But if you can become more honest about your own relationship with greed and fear, if you can do something as simple as increasing your investing time horizon, that is something that will give you an edge over the average investor out there. I think there is a broader point to this too, in that I think for most individual investors particularly, my question would be, why are you necessarily looking for an edge? The market will give you a great return out there if you just take it. And rather than looking for an edge over your competitors, over your brother, your coworkers, your niece and nephew, whoever it might be, to me, it's just how can you achieve the broad return that the market is going to give you over time? There are a lot of people who would say, like, index investing is so simple and it's so basic, but a lot of people will not be able to actually capture the index's return over time because of their behavior. So if you can focus on your ability to just take a longer term time horizon, that is, I think, where where individual investors and professional investors can find what looks like an edge in their investing endeavor.
Okay, you talked about patience, and and how possibly to cultivate some of that. What about the vision, the courage? You've also mentioned how there is so much information out there, and investors can make better decisions. How do they kind of cultivate that skill, that really grow that vision on how to pick those opportunities, find those opportunities that will get them manifold returns in the long run?
To me, what's most important about picking opportunities is the idea that investing, but also a lot of areas of life, you're going to get the majority of your gains from a very small minority of the stocks that you pick. That is always the case. That is true for the best investors in the world. It is true for broad indexes over time, that the majority of the gains come from a small minority of the stocks that you pick. And therefore, if you are a stock picker looking for opportunities, to me, the biggest mindset that you can gain and the most important thing to think about is that if you are to make, let's just say hypothetically, 50 investments, over the course of 10 years, probably something like half of those investments will not work out. And if you are lucky, if you do well, 5 or 10 of them will account for the majority of your returns. And that's if you do well. That's the picture of success. It's not intuitive to wrap your head around that is the path to success. But we see that, again, with people like Warren Buffett, George Soros, all these investors where the majority of their gains come from a small minority of their returns. Benjamin Graham, one of the most famous investors of all time, the father of value investing and Warren Buffett's early mentor, virtually all of his career investing success comes from one investment in Geico. And if you remove that one investment, his entire career track record is average. And I think that is a much more common story than we want to think. So if you are someone who is looking for opportunities, looking for big wins out there, the most important mindset that you can come to is understanding that in the normal path of what you do, you are going to be wrong upwards of half the time, and that is okay.
Awesome. What about the new breed of Robinhood traders, Morgan, who seem to be in for a quick return with no real deep understanding? What are you, making of this trend? Does it concern you?
I think there's two sides of this. One, I would rather investors learn these hard lessons when they are young and don't have very much money versus when they are older and really trying to actively save for their retirement or their kids' education, things like that. So when you have a lot of young investors that are literally buying bankrupt companies and trading options all day, you kind of know how that story is going to end. We've seen that story play out over various generations, of course. And the Robinhood app really makes investing gamified. It turns it into a game to where it looks like people are just playing a game. What's dangerous about that, though, is that it's not a game. It's real money. And of course, there was a case in the United States this summer, a very tragic case, where a young investor on Robinhood was trading options, and there was kind of a quirk in the user interface that made it look like he had just lost $700,000 even though he didn't, and he committed suicide. Which is just an example that this is not a game. And even though it's fun and there are bells and whistles and balloons that come up on your screen, it's not something that people should take lightly. So that's kind of the two ways that I look at it. I'm glad that investors are learning about the downsides of risk at a young age. I think that's only, you can only learn those lessons firsthand. But at the same time, we really need to be careful as a whole investing community to not make investing a game. It's a long-term endeavor where you're investing in real businesses. And anytime that we make it a short-term endeavor, a short-term trade, you're just relying on a much higher degree of luck to fuel your success.
Understood. Now, everyone knows that the power of compounding is the most important thing, yet everyone's watching what happens the very next morning. Everyone's waiting for that multi-bagger and that stock to just explode and get them great returns. So constantly eyeing the market level. Why is that?
I think it's natural that even if we intuitively know it is that investing is a long-term game, that we need to be here for 5, 10, 20 years to get the biggest returns, if there's information in front of us in the short run, we're going to look at it. I'm the same way. Even as someone who thinks about long-term thinking and writes about this for a living, I still check my stock portfolio on a somewhat regular basis. I don't make any changes to my portfolio when I look at it every day, but I still look at it because I think it's interesting. I think it's fun. So it's hard to, if your account balance is going up or down, it's hard for a lot of people to just 100% ignore that, even if you're not going to take any actions. So I think it's normal to look at the information and to want to know what's going on today. The issue, the danger, is when people use that information to make decisions in their portfolios, to take actions in your portfolio. That's when it gets a lot more dangerous, is when you are not just looking, but you're actually trading.
Okay. We've seen two major shifts with interest rates at decadal lows, as well as tech being the next big thing, or the current big thing. Talk to us about some of these changes and what they really mean for future investors.
So there was the quote from Microsoft CEO that in April where he said 3 years of tech progress took place in 3 weeks this year. So I think that's a lot of what happened in technology. A lot of trends that were already existing just got really sped up in this year. Things like what you and I are doing right now. Video conversations this year. That was already a trend that was going, but just exploded. So I think one takeaway from that is that one of the biggest the biggest stories in the economy over the last 30 or 40 years is the growth in wealth inequality in that's taking place all across the world. That trend just exploded this year. And if wealth inequality was growing for the last 30 years, it is now growing much faster than it ever had. Because you have tech companies that can do their business when people are working from home, their employees can work from home, and then you have another subset of businesses that can't. And it creates this stark divide over the haves and the have-nots that we have not seen. So, of course, you have companies like Amazon, Google, Microsoft, Apple, those kind of companies that are doing better than they ever have before. Not just their stock prices, but their businesses are doing better than they ever have before. And then on the other hand, you have restaurants and hotels and convention centers that are in a situation that is literally worse than the Great Depression. So I think that's just the new divide. Like the tech companies that we always talk about already had tremendous power and market share, but it is an order of magnitude more this year. I don't think that's an exaggeration than it was earlier this year. So it's just a new level of strength that we have for businesses that are able to conduct their operations 100% digitally and online.
All right. India's most successful investor, Rakesh Jhunjhunwala, he says that one of his biggest successes, Titan, was a pure luck investment. How can, again, one cultivate a more reasonable, rational style of investing, become a better investor when you are speaking about some of these soft skills and psychology and behavior in your book? Share with us a few more anecdotes on really how one can cultivate these skills.
I mean, one anecdote that I think about, that I read about in the book, is the story of a guy of Vanderbilt, who was one of the most successful businessmen of the 18th, 19th and 19th century, became one of the richest men in the world, one of the richest men of all time. And if you go back and read his story about what he was doing, he was breaking the law left and right, and he was almost proud of it. So you could easily imagine us looking back today about his story ending up as someone who ended up in jail. He didn't, but he was constantly pushing that boundary. So I think the line between people who are very successful and very unsuccessful can be really thin. And we often only know that in hindsight. To me, one of the best ways that you can figure out if an investor is lucky or actually successful is how they have performed in different environments. Can they succeed not just during the big bull market, but can they actually do well during the bear market as well? Can they do good not just in this economy, but in last era's economy and the next economy as well? I think it's something that one of the issues that we have when we're trying to find investing role models and people who we really admire is that it really takes 10, if not 20 or more years to determine whether an investor is actually legitimately successful or not, that their success is driven by their actions and not necessarily luck. So when it takes that long to really size someone up and judge them, it just gets a lot harder to find role models, because we don't want to take 20 years to see someone's report card. We want to see how they did in the last year or the last quarter, and then really admire them for what they've done in the last year. When you and I are talking right now, or if anyone is talking about investors, 1 year or 5 years seems like a long time. But if you understand like how much time you actually need to identify success and how it needs to come in different economies, different market environments, then I think it takes at least 10 or 20 years to do. So it's that disconnect that I think leads us to have that disconnect between lucky investors and knowing who the investors who are legitimately successful over time.
Sure. Do you think, Morgan, that the current bull market will continue? Buffett has always said that interest rates will act like gravity and will remain low, and will act like gravity. And currently it does seem like the force of gravity is missing.
I think that's a great point. With interest rates where they are, what that really does is it makes it so that stories about what the future might be are more important than what the present actually is today. When the interest rates are nothing, and there's nothing kind of pushing back against current results, then a story about a narrative about what people think the future might be is really important. What's true, I think there's a broader point that if 2020 has not made you humble about our ability to predict what's going to happen in the future, then I don't think anything will. I do think, though, that you could coherently make an argument on extreme sides of the equation for 2021. One of the arguments would go something like this. If we get good vaccine news in the coming months, and there is kind of a global vaccine in early or mid 2021, then you combine the amount of pent-up demand that people have all over the world, demand to go on vacation, to go to restaurants, to get back in the world and do the things that they were forbidden to do in 2020. And then you combine that with a lot of the government stimulus from central banks and others around the world. You put those things together, and you could argue that 2021 could be one of the best years for the economy that we've seen in our lifetimes. You could also argue that if there is not good vaccine news in the coming months, and governments around the world kind of fail on stimulus measures, that 2021 could be literally the worst year for the economy that we've seen since the Great Depression. So those are the two extreme ends that I think are equally feasible right now. And I think both of those ends people are probably not giving enough weight to, particularly the optimistic side. It's hard as we sit here in 2020 with tens of millions of people unemployed in the United States to have any sort of optimism about what might happen in 2021. But it's usually coming out of those big, deep recessions, the big depressions, that you tend to see the subsequent strongest economic growth that comes after it.
Okay. What also do you feel is going to be the impact on emerging markets, and in particular India? I have to, ask you a couple of these questions as well, because, we really must get your view.
I think the biggest thing that was going on with, in terms of the globalized economy, and this predates COVID-19, of course, are the international trade wars and tariffs that really got accentuated with Donald Trump as president. And a lot really hinges on where that's going to go in terms of whether he wins or not in our election that takes place in 2 months. If he does, then the continuation of the trade wars and kind of the dismantling of globalization that's taken place over the last 20 years seems like a pretty good bet. If Joe Biden is president, then I think most of those trade wars that have been put on in the last 3 or 4 years will be dismantled themselves. And we will go back much closer to a world that looked like 4 or 5 years ago when globalization was running full steam ahead. So I think there are a few times when one single story is really going to make a huge difference in terms of where that trend goes. And the election this year is definitely that event. It's one of the few times that we can say, well, depending on which way this goes is really going to determine where globalization goes for the next, not just 4, but probably 10 or 20 years.
Wow. Okay, so it is going to turn out to be quite a significant event for the world. Morgan, if you had to pick an asset class for the next few years, what would it be?
Mine is always, and this would be my answer whether we were in a recession or a boom or had high inflation. My answer for the best long-term growth is going to be a diversified index of good stocks. That's always what it's going to be. And it's not just that that's what history has done, has shown is one of the best assets that you can own, but it's the idea that if you fundamentally understand what the cost of admission is for those returns, that if you are able to put up with the poor short-term performance, the idea that stocks can do very poorly not just this year but over the next 3 or 5 years, which is always the case. But in exchange for that, in exchange for putting up with that, you are going to have a much higher degree of certainty of earning superior long-term returns than you could in any other asset class. That's, to me, why they get so appealing. Certainly with interest rates at 0 today, cash and bonds you're not going to get much out of. You would be thrilled to keep up with inflation in bonds over the next 5 or 10 years. So there's not a lot of alternatives other than good companies right now. Of course, in a lot of areas, including the United States, they are expensive. They are, by some measures, more expensive than they've ever been or have been in decades. So I think adjusting your expectations of what you might get out of your stocks on a globalized view is smart. But it's still, when you look around at asset classes, it's hard to think of another asset class that's going to do well over the next 5 or 10 years. Not necessarily the next year or 3 years, but if you're looking at a longer time frame, it's still the place where I would want my money.
Okay. What about index funds, Morgan? Explain to us your thought behind investing in index funds. Because you understand greed and fear so well. So why index funds?
I think when you invest in an index fund, you're making a very specific bet. You're not betting on any sector. You're not betting on any specific stock. What you're betting on is capitalism. You're betting on humanity's ability to solve problems and for those problems to make us more productive, for that productivity to lead to profits, and for the profits to accrue to shareholders over a long period of time. So I always view an index fund as just owning a slice of the global economy. And that's the bet that I'm making on. And when the bet is that broad, and it leads to me, in my view, the highest odds of it coming true. Like if I were to bet on oil prices, you can come up with a coherent argument about which way they might go, but you're relying on a lot of uncertainty in that. Whereas if the bet that I'm making is that over the next 30 years, people will solve problems and become more productive. That is a bet that I can put much more confidence in than any other, than I can make in any other specific bet that I'm making about the economy. So it's just the degree of confidence in the bet that I am making that is so important in my my index funds that I invest in.
Sure. In fact, I wanted to ask you how one could gain productivity in time and life, but I know we're also running out of time. But I'm going to, let you come back with anything you want to mention there, as well as just touch upon how you've really brought out some, personal examples as well, such as, your stuttering and how you overcame that when you were younger. Would you like to share that with us here now?
Sure. No, I've written about this. I'm always more than happy to talk about it. People might even notice it on this recording that we've done. I've grown up with a severe stutter when I speak, which is a disability that not a lot of people talk about. Most stutterers don't talk very much, which means that everyone else doesn't get a chance to watch them do it, which means a lot of people just don't know about it. It's more common than people think, although it's still fairly rare. And for me to grow up to in that situation of barely being able to talk during my teenage years, to now have a job where I get to talk to you and people like yourself all the time, has really been a good development for me. We saw during the Democratic convention a couple weeks ago, a 13-year-old boy with a severe stutter, just like Joe Biden has. Joe Biden also has a stutter that he's grown up with. This 13-year-old boy went on air and read a note about Joe Biden and stuttered the entire time. And it was so inspiring to watch. For people who have disabilities, to be able to do something like that and put themselves out in the public, I think is really inspiring. To me, there's always been this broader point of this idea that every single person has skeletons in the closet. They have challenges that they're dealing with. And I think if you understand those challenges and you're more open about your own challenges, then you become more empathetic about what other people are going through. And just realizing that everyone's trying to make it through the day the best that they can, do the best that they can, the best work that they can, even though if we're all dealing with challenges and we all have these struggles that we're trying to get through.
That's a beautiful point, Morgan. Just as we wind up today, one last question. Why is it so difficult to find good, active fund managers, or enough of them out there?
I think there have been a lot of studies that actually show a little bit more nuance, which is that it's not hard to find good active managers. It's hard to find good active managers that overcome the fees they charge. So if you have a mutual fund that charges a 1% fee, then even if the manager outperforms by half of 1% per year, which is pretty good, the fee is going to take all of that outperformance. So that's really where it comes down to. It's not necessarily that people cannot find good stocks. It's that the business of investing, the economics of the investing industry, just make it a much higher hurdle to overcome than it is in other fields.
Fantastic. Morgan, always a pleasure. We look forward to reading your book here in India, and with all the insight that you have on behavior and psychology and how it really impacts investing, the deep study that you've done over all these years. It would be wonderful to also get our hands on the complete book. Thanks so much for joining us, and all the best.
Thank you so much for having me. I appreciate it.